Are tariffs the new inflation? And is the bond market more afraid of Washington's trade war than the Fed? And how the heck did we go from 6.92% to 6.99 midweek, only to end back at 6.92? Well, hey, I'm Mike Petras with MPRE Boise, powered by Nextone Treasure Valley. And while I do serve the Greater Boise, Idaho area, this update covers what's happening nationwide in the mortgage market. Before we dive in, go ahead and hit the subscribe button below, hit the notification bell so you're constantly in tune with these videos as they do pop up. And please, if you do enjoy this content, hit the like button as well. And go ahead and feel free to share this information with anybody trying to make sense of what's going on in the mortgage market. So let's get into it. What happened this week and what can we expect coming up? Well, this week was really like a duck on a pond, calm on the surface, but paddling like mad underneath. We started the week with the average 30-year fixed mortgage sitting at 6.92% on Monday, and that same rate held into Tuesday. But by Wednesday, we saw a quick jump to 6.99%, the highest since mid-April. Thursday ticked slightly lower to 6.94%, and by Friday, we were still back to where we started at 6.92%. This flat finish hides the midweek storm. Lenders repriced multiple times throughout the day on Wednesday, reacting to sudden spikes in bond yields. Even alternative loan types didn't escape the volatility. Jumbo rates flirted with 7.10 midweek before cooling off to 7.05, and FHA and VA loans followed similar arcs, brief peaks before settling down. The consistency across the loan types reflect a broader market tension, which has just been occurring over the last few weeks. So what moved rates this week really? Well, inflation used to be the headline grabber, but not anymore. Now it's all about trade policy and global confidence in U.S. debt. CPI even came in Tuesday right where economists expected. In fact, a little bit cooler. Normally, a result like that would ease rate pressures. But this week, markets barely flinched. And why? It's because they're trading on bigger worries. After recent tariff escalations and then a 90-day pause announced by the U.S. and China, traders are reacting less to monthly reports and more on fiscal chess moves. Investors are asking, will foreign countries still buy treasuries if we're lobbying trade threats? Will tariffs choke growth or spark inflation? These are the structural questions that dominate the bond markets right now. Even a slate of Fed speeches from Waller to Jefferson to Powell couldn't settle the markets. And by Thursday, softer than expected PPI and weak retail control group numbers gave us a brief reprieve, but even that couldn't reverse Wednesday's damage. So what's the moral of the story and what should we be looking out for? Well, we'll get to that a little bit later on here in this video. But the question is right now whether to lock or float if you are looking to make a home purchase right now. Well, let's not go ahead and overcomplicate this. If you're under contract and the rate you've been offered works for your monthly budget, you should probably lock it. Yes, we saw a dip on Thursday, but we're still playing in the high sixes and volatility is relentless. For home shoppers not yet under contract, you may want to float, but with caution. We've seen multiple whiplash-style reversals in the last few weeks. And if another surprise headline drops, especially around tariffs, Treasury auctions, or international buyers pulling back from U.S. debt, rates could jump before you even have the time to react. So what's coming up next week? What can we expect? Well, the economic calendar looks lighter, but don't relax just yet. We'll be watching jobless claims, housing starts, and Fed commentary, but none of these are expected to make a huge splash on their own. The bigger watch is political. The market has clearly shifted from watching inflation and job numbers to watching tariff policy, debt issuance, and foreign investment behavior. If Trump, Congress, or China throws a wrench into any of these themes, the bond market, and by extension mortgage rates, could swing hard and fast. In other words, even with calmer data, headline risk remains high. So yes, while mortgage rates didn't blow out this week, that doesn't mean they're stable. A market that moves 7 basis points midweek only to return to its starting point by Friday isn't calm. It's confused, and confused markets are dangerous to float in. So if you're getting ready to buy or refi, your best defense is to stay informed and stay agile. Let me know in the comments, Are you looking to lock, float, or are you just waiting it out? Well, hit the subscribe button if you want to stay in tune with this information, and hit the notification bell so that you're constantly in the know. And feel free to share this update with anyone tracking the mortgage market. And remember, while I am a realtor, I do have great loan officers that can help you all the way across the country. But remember, if you are looking to relocate to or from the Greater Boise, Idaho area, I'm your go-to resource. Well, again, I'm Mike Petras with MPRE Boise. Catch you next week with the next mortgage update. God bless, and I look forward to the day that I call you my neighbor.